Bismillahirrahmanirrahim. There has been some recent interest in the concept of 100% reserve banking. So I'm going to explain the mechanics and some implications of 100% reserve banking in this video. So let's start with an example and imagine a state of being where there are no banks. So imagine there are no banks in a certain town, and before the introduction of banks, the town holds all the money in physical form. So as you can see in this table, the total money supply is $100,000, which is entirely in the form of cash. So if you see the first row, total physical money in town is $100,000, and the total money supply is $100,000. And since banks don't exist, the money deposited in banks is zero, and the effective money supply is $100,000. So now imagine a new bank is opened, and this banking system is 100% reserve banking. So let's say the people decide to deposit $80,000 in the bank, and they decide to hold $20,000 in their pockets. So in this case, the total money supply still remains $100,000. So there is no change in the money supply. Just like before, the total money supply in the economy is $100,000. $20,000 in the pockets and $80,000 in the bank accounts. So in 100% reserve banking system, banks are just like safekeepers. They do not expand the money supply. So how does lending happen in a 100% reserve banking system? So the only way that banks can lend out money to the borrowers is if they have savers who have saved money in the savings account. So the banks cannot touch the money which is deposited in the current accounts. So that is the demand deposit, which must be held at all times. However, let's say the customers have a savings account, or they invest money, or they save money in a savings account for a duration of 1 year, and that money can be lent out by the banks for a duration of 1 year accordingly. But anything in the checking account cannot be lent out for expanding the money supply. So what are some of the implications of 100% reserve banking? So first of all, there is no multiplier effect. So this system ensures that banks always have sufficient reserves to meet all depositors' demands. So this 100% reserve banking offers high security to the depositors, but limits the bank's ability to create loans and expand the money supply. So deposits in the current accounts are not available for lending due to the 100% reserve requirement. The second implication is the bank revenue. In such a 100% reserve system, banks can charge fees for safekeeping money in the current accounts and for facilitating the transactions. However, they cannot earn interest from loans, which is typically associated with fractional reserve banking. So their main source of income becomes the fees which they charge to the customers for their services. The third implication is economic implications. So while 100% reserve banking is more secure for the depositors, there cannot be bank runs. People always have the assurance that their money is safe, and they can just knock on the door of the bank and get their money back. However, this may lead to a less dynamic economy with fewer investments, with fewer loans, and sometimes even productive projects may not be funded because of the non-availability of enough reserves in the system. Finally, the last implication is this 100% reserve banking system requires a separate arrangement for lending. So either this could be separate institutions like investment banks or investment management companies. There have to be separate arrangements for lending. Or if people save their money in the savings account, of course, banks can use those savings for lending, or there is a need for separate institutions to promote investment and productive activities in the economy. So I hope this was useful. If you have any questions, please leave them in the comment section below. Thank you.